Good afternoon, everyone, and welcome to B&M Care's funding webinar in association with SOLLA accredited financial advisors, Eldercare Solutions. My name is Angela Hunt, and I am the Sales and Marketing Director for B&M Care Homes. A warm welcome to our existing families joining the webinar today, and also welcome to those of you out there stepping into the world of accessing long-term care for your loved ones and wading through the minefield that is finding ways to fund that care. B&M Care have been operating care homes for 50 years now, and we take the view that providers like us have a real responsibility to share our knowledge with our families as well as the wider community. So today's webinar is part of a series of discovery events that we deliver, which includes the Dementia Awareness webinar and the virtual dementia tour. You can go look at our website again, bmcare.co.uk/events for any of those upcoming events. So let's move on to today's event. I will hand you over now to Nicky Cave from Eldercare Solutions, who is going to take you through today's care home funding webinar. Over to you, Nicky.
Thank you very much, Angela. I shall just share my screen and hopefully you can let me know that you have. Oh, hold on. Can you see that? I can't. Just.
No, can't see your screen.
No, hold on. First time we've had one of those blips before. There
There
we
you
go.
go. We can see you.
Excellent. I've only been doing these for about 5 years. I should know better. So thank you everybody, as Angela said, for joining. The good news is this is being recorded, so you don't need to worry about taking notes, or if I go through something a little bit too fast, you've got the benefit of a recording later that you can rewatch. You'll also be able to send that recording to friends or family or anybody else that you think it might be useful for. As it's a webinar, you don't need to worry about your cameras and microphones not working. That's already taken care of, and you won't be able to accidentally switch them on. If you do have any questions, because we have a large audience, it's going to be better if you get in touch with us afterwards. We'll make sure you have contact details, or Angela can provide you with those, and we'll pick up any specific questions that don't get answered this afternoon. We'll pick those up individually with you. So just to make sure you are on the right event, I'll give you a quick agenda of what we're hoping to cover this afternoon. And I very much deliberately picked that road sign as the image because a number of you will be at different stages of the journey. But if you have travelled quite a long way down the journey, but remember at the beginning, did it all feel quite confusing? Were you quite disorientated and bewildered and maybe getting mixed information from various sources? We certainly felt like this when we first dealt with our family needing care advice. So this afternoon's agenda is to look at a very simple question, but it has quite a complex answer. Who actually pays for a stay in a care home? We're going to consider what has or hasn't happened to something you may have read about in the press, the lifetime cap on care costs. We're going to look at whether the family home has to be sold to fund a stay in a care home. And in closing, we'll look at how you might be able to protect some of the estate, some legacies, and make sure that if you have put money aside or earmarked funds to pay for care for you or a loved one, to really explore an option to make sure that that doesn't run out. We know that's a big concern for families. You'll see our website address throughout, eldercaregroup.co.uk, but at the end I will give you phone number and email as well. Now, just before I start working through that agenda, which will hopefully address the questions you've come here with, I suppose, let me give you a bit more of a formal introduction to ourselves. So here at Eldercare, we are a firm of IFAs, independent financial advisors. We've all been accredited by the Society of Later Life Advisors, which is really the sort of gold standard for advisors giving advice in this area. But unlike a typical IFA, and even unlike many of our sort of SOLLA peers, we only advise, we specialise exclusively in solutions for care fees funding. So if you needed advice about taking your pension or taking out a mortgage or setting up some life assurance, although technically an IFA should do that, we don't do that. it's been 25 years since I've given that type of advice. Conversely, most IFAs won't deal with care fees funding solutions very often. Even if they have gone through the SOLLA accreditation, it might be something that they don't really practice very often. So it's very, very niche, and it's an area that we've chosen to specialise in, and it is my company. And it's been set up really just as a result of us going on this journey and getting no advice when my grandparents needed to move into care. Now, that wasn't anybody's fault that we got no advice. You don't know what you don't know. So we didn't ask anyone. We just assumed we were doing all the right things. We knew they had a property. We assumed we had to sell it. And we kind of just kept our fingers crossed to hope the money didn't run out. It did. And it was really when I found out later in my career that there was a solution that could have prevented that happening that the company was set up. Got on my soapbox and haven't stood down since. So it's a very much a mission, shall we say. And we work with care providers up and down the whole of the UK. We have no commercial link with any of them. This is just about getting really important information out to the people that need it at the time that they need it. We are having money conversations with people. So as a financial services firm, you would expect us to be properly regulated, and you will find us easily on the Financial Conduct Authority register. And I'm obviously talking to you today by this wonderful Zoom discovery from 2020. I didn't know about Zoom before 2020. And I am in Hertfordshire, so I may be quite close to some of you, but actually even pre-pandemic, we were delivering our advice remotely, predominantly telephone, predominantly email, sometimes post, which we try not to use anymore because it's so bad. But obviously we can now have virtual chats as well, but we do it that way to keep our cost base down. If we're not having to travel and factor in travel time, we don't have to bill people for meetings. So you can pick up the phone to us or drop an email and get completely free advice at our expense, not yours. It also means if we've got this kind of an audit trail, the emails, then nothing gets lost in translation. So if I'm talking to one sibling who's got to communicate the information to another, isn't it better to have my words in writing to pass on rather than try and remember what was said? So as I say, this low cost based model means we can chat to you, give advice free of charge. We can even research the financial solutions I'm going to talk about later with no charge to you. We firmly believe it's about getting the information and advice to you with no barriers to that. So that's us and why we do what we do. Let's go back to the agenda and that initial question, who pays for what? Now, if you are at the beginning of the journey, this may all be news to you. And if you are towards, that you've already found a home, your loved one's moved in, you may know quite a lot of this already. So bear with me. Trying to keep it simple, I would say that you are funded in a care home either by the local authority, social services, the council. That's actually all the same place. We just call it different things. You could be funded in certain scenarios and in certain types of care home by the National Health Service. Otherwise, you will be a self-funder or private fee payer, so paying your own way. Sometimes there is a crossover between these streams, but as I say, I want to keep it simple for now. If we take that first one, the local authority funding stream, anyone who is familiar with it might realise it's typically linked to how much money you have, but there is actually a step before that. If you were to contact the local authority and ask them to carry out an assessment to pay for somebody's care, what they actually have to do first and foremost is to assess their care needs. So to carry out a care needs assessment, anybody can ask for a care needs assessment, including carers who might be entitled, for example, to some respite care. Now, when the local authority assess somebody's care needs, there will be some people who don't meet the criteria, and an Age UK survey a few years back said roughly 1 in 5 would not meet the care eligibility criteria. So if the local authority don't agree that you need to move into care, so for example, my widowed aunt wanted to move into care because she suddenly felt quite lonely and unsafe on her own. So it was really just to have that kind of social interaction and maybe someone doing her laundry and cooking for her. What's not to like about that? But if she were to be assessed by the local authority, they would say you don't need to move into care. You might want to. You don't need to, in our opinion. So we're not having any further conversation around funding. So it's a care needs assessment that happens first, and then a financial assessment takes place for those that meet the care criteria. A financial assessment could be more commonly known as a means test. And I'm sure if we were all in a room together and I said to you, what's the entry point, what's the capital limit for qualifying for local authority funding, you'd all shout a figure at me and probably be correct, that it's £23,250. You'll likely be correct because that hasn't changed for years, or about a decade. So in real terms, that's going back in value, isn't it? There was talk of it changing to £100,000 entry point, but that's completely been kicked into the long grass. People talk about it being free or generous in Scotland. The capital limit is only a few £1,000s more in Scotland. It's actually at its most generous in Wales, where it's £50,000 at the entry point. So this is how much money you have this or underneath this in order to qualify for financial funding. This is per person. So if we are talking about a couple, we can double these figures. Now, what actually counts as capital? If I'm being flippant, I would say pretty much everything, because it is pretty much everything. There are three notable exceptions that are worth a mention. We are talking quite often to couples where one of them is moving into care and one is staying at home. In that scenario, it's only the spouse that's moving into the care home whose capital can be assessed. So 100% of the capital owned by the partner staying at home would be disregarded. If you own things together, so a joint savings account, then 50% of that value would be taken into account, 50% would be disregarded. That means, and without me sort of going into a worked example on this, there's an Age UK fact sheet I can send you to demonstrate the point, but there is a definite argument for separating out any jointly owned savings and investments. Obviously, ISAs are already individually owned, but anything else that you own jointly, the one who is not moving into care really ought to take their 50% out and put it into an account in their own name. Otherwise, there is a danger that some of that will get spent inadvertently on their partner's care. We're not talking about messing with the percentages or taking out anything more than 50%, and this is not deprivation of assets. It's just separating everything out so it becomes much clearer who owns what, and only the correct individual's capital is taken into account. So if you need any more advice on that, obviously that's something we can pick up subsequently. The house, the property, the family home. This is again an area that I assumed people felt fairly secure in their knowledge about, but we take lots of calls of families worrying that half of the house will be taken into account when a spouse or relative over 60 still lives there. This is absolutely not the case. If there is a property, husband and wife, partners living together, and one moves into care, the property value cannot be included now or in the future at any stage whilst the other partner lives there. So families that are worrying that the council will come back later and claim the money, absolutely not. That property is invisible as far as the financial assessment is concerned, while the spouse or a relative over 60 lives there. Now, the relative over 60 can't have just moved in. They have to genuinely live there and have been living there for some time. And there are some discretionary disregards as well, but these are the main ones that are mandatory. I'd also just point out if the spouse who's staying in the family home decides to downsize, then if that's again tread with caution, because if money is released as a result of that downsizing, half of it, of course, will suddenly appear in the financial assessment for the person in the care home. So again, any concerns around property ownership and whether it is included or it's not, do pick that up with us subsequently. And the third exception, not perhaps so common, but common enough to get a mention, if during someone's lifetime they have taken advice from an IFA typically and invested some money in order to try and beat the sorts of returns that they would get in the bank or building society, they may well own an investment bond that has life assurance included. Don't ask me why, but investment bonds that include life assurance have to be disregarded by the local authority, so they can't be included. You can still choose to cash them in and use them to pay for care. That's absolutely your prerogative, but the start point is that the local authority wouldn't include them in any financial assessment. Otherwise, pretty much everything, so second homes, holiday lets, business ownership, shares in businesses, money under the bed, stocks and shares, ISAs, premium bonds, national savings, money at the bank. All of that is treated as capital as far as the assessment is concerned. Now, unfortunately, it doesn't stop there. Income counts as well, and this is usually completely overlooked by many. Again, if you've not had experience of the system, why would you understand these nuances? So that's why we want to give you this information as early as possible in your journey so that you don't make these same kind of not errors but misunderstandings. Because if you were to consider going into a particular care home as a self-funder and thinking ahead to what happens when the money runs out, if you were reassured that the local authority would pick up the tab and pay, you might be aware that they have a limit, the local authorities have a limit to what they will pay for someone's care. I suppose that's quite obvious. But in arriving at that figure, they have to assess needs. Okay, so that's really important. But you'll be told a figure and you might think, oh, okay, well, if we add mum or dad's pension on top of that, their private pension and their state pension, we actually won't be too far different from the fee we were already paying. But the problem with that is that when the local authority work out what they're going to pay for somebody, they deduct your income from that. They expect you to contribute your income towards what they will pay. So suddenly you realise that that pension can't be added as a top up. You're in effect going to have to give that to the local authority to subsidise what they're going to pay. Now, if you do have a spouse staying at home and you have a private pension, they can keep half of it, but otherwise, pretty much all of your income has to go towards what the local authority will pay. And again, I mentioned just then that they have a limit on what they'll pay. It does vary even within county, but let's say we pick a figure of £800 a week. The local authority, if they are being asked to pay for somebody from outset, they have to actually offer a care home place that meets that person's needs and who will accept the £800 a week. If every care home in the county says, no, we won't take 800, 900 is the minimum, then the local authority has to pay 900 because there must always be at least one place that's offered that meets the individual's needs and that does not require anyone to pay a top up. So the local authority have to fund it in full, accepting that you pay your income towards it. So I mentioned their top ups. So two situations really where a top up could be asked for, a third party top up. One, the scenario I've just outlined where the local authority are responsible for paying for someone's care from outset. They offer a place, they do agree to pay for it. It does meet the person's needs, but the family or the individual chooses or wants or would prefer to go somewhere else, perhaps somewhere that's got better facilities or somewhere that is nearer to family, they can then choose to go somewhere else. The local authority's fee is transferable, but that home may be more expensive. And if that's the case, then a third party top up can rightly be requested. So that's one scenario where it can be legally asked for. The other is if the individual starts off as a self-funder, starts off paying for their care themselves and subsequently runs out of money. Depending when that happens, i.e. is it 2 or 3 months after they've moved in or is it 2 or 3 years after they've moved in, what conversations took place when the care home contract was entered into, what indeed does the care home contract say? Certain situations, somebody runs out of money, the local authority step in. A third party top up may be requested by the care home. As I say, if it's happening soon after they've moved in, it very likely will be requested or required. If it's a number of years down the road, it's going to be more open to negotiation. What should always happen is a best interests meeting involving the local authority and the individual, their representatives and the care home, and those parties will try and reach a mutually agreed fee. But if you're not sure, if you're at the point of choosing a care home, this is a really good question to be asking up front. What happens in the event that the money runs out? And just be sure that you know where you stand so that there are no surprises further down the road. So that's a whistle-stop tour of our means tested system. It's our safety net system. It's been around for decades. We keep getting governments talk about changes to it, tweaks, improvements. The latest was the introduction of a lifetime cap on care costs. Now, this was never going to replace that means tested system. The means tested system was here to stay, but the lifetime cap was something new to run alongside it. In essence, it was supposed to take away the fear of complete estate erosion if somebody were in care for a long time. And up until probably almost exactly actually a year ago, I would have been spending the next 5-10 minutes on a few slides explaining to you how the cap would work, explaining to you that actually it's not all it seems, that actually it's only the local authority rate of care that would count towards the cap, not what somebody was actually spending on their care as a self-funder, that it might actually take 4 years for most self-funders to reach the cap, and to point out that you'd still probably have to contribute quite a lot even once you reach the cap. But I'm not going to spend the time on those slides, because what I can tell you is that 86,000 cap has been completely cancelled. Not even delayed. It was delayed from 2023 to 2025, due to happen in approximately 3 months' time. It is not happening at all. And you'll keep an eye on the press, no doubt, and see that this is again under consultation, but we're really not hearing anything about changes to the financial side of the system at the moment. So I think you have to carry on accepting that our means tested system, maybe with a few tweaks in the future, but that's what we're dealing with at the moment. So, second funding stream, the NHS. Again, unlikely to, I suspect, impact most of the people watching this at the moment, because it tends to be something that features much further down in a lot of people's care journey. But there are certain situations where somebody's care will not, the funding of their care won't be linked in any way to their finances. It will be linked to their care needs and whether they have significant healthcare needs. So in the same way, this is a very basic explanation, but in the same way that you don't pay for a stay in hospital, you don't get discharged and come out with a bill to pay. The NHS funds hospital care. If you have similar healthcare needs and you have to be looked after by somebody with medical qualifications rather than social care qualifications, then just because it's in a different building, not a hospital, it doesn't mean that the NHS don't pay for it. They should still pay for it just because you're in a different setting, provided it is a primary healthcare need. So they use terminology like complex, unstable, unpredictable when referring to the care needs. And we can, again, give you a really good Age UK fact sheet that shows you effectively how the scoring is done and how they work out who qualifies for it and who doesn't. But as I say, if you're in a residential care home having predominantly personal and social care, this won't apply. But should you need to move to a nursing home in the future, then it may be that all of your care costs could be met by the NHS, or at the very minimum, you would get a contribution towards those costs. It's currently £254 a week, paid directly to the care home. And the idea of it is to sort of almost bridge that gap between a residential care home fee and a nursing care home fee. So just be mindful, as I say, it's an event almost in itself, and I wouldn't be the person hosting the event because I'm not medically qualified, but it is a complicated area, and it is quite difficult and becoming more difficult to make a successful claim. But certainly something just to know about, just to think, oh, I might need to revisit that in the future and just be aware of it. However, if you are not eligible for local authority funding because you have too much money, in essence, you're not eligible for NHS funding because you're not poorly enough to meet the criteria, that is what puts you into that third funding stream, the self-funders, the private fee payers. Now, the only, and it really is almost the only positive I can give you this afternoon, is that you can claim or continue to receive a state benefit called attendance allowance. So this is not means tested, tax free, doesn't need to be put on a tax return. It's not a huge amount, but if you were to get the higher rate, it's not too far short of £6,000 a year tax free. And anyone who is self-funding their care and has care needs should receive either the lower or higher rate. The difference between the two is if you need somebody to attend to you during the night time. And a sort of tip for the form, it's quite a long form if you need to put in a claim. If you've already claimed, you'll have battled through this already. But if you are putting in a claim, the distinction between the two rates, you would need to demonstrate that there was about 20 minutes worth of attendance during the night time, or three visits, if you like, from a carer. So lots of people, if they've heard of this, think it stops when you move into care, and equally there are lots of people that haven't heard of it. It would only stop if you are in hospital for a period, or if you become local authority funded at a future date. They will then effectively switch this off. Okay, so if you need links, or I mean, to be honest, if you just Google attendance allowance, it should bring you up the government website and lead you straight to a claim form number. The only other state support really for self-funders, it's a bit of again a niche category, but lots of people are in this category. People who own a property that is not going to be occupied by a spouse or relative over 60. So in other words, a property that does form part of the means test, it's not disregarded. If the person moving into care is in effect leaving that empty, and they're moving into care on a permanent basis, then for the first 12 weeks of that permanent stay, the property has to be ignored, which means that if their other money is under the 23,250 threshold, they'll actually get state funding for those 12 weeks. So they will be treated in exactly the same way as somebody who is fully local authority funded, but just for the 12 weeks, by which I mean the local authority will use their lower rate. They're not going to cover the full cost of care. They're still going to expect the person to contribute their income towards it. But for most people, it might work out as a sort of £300 or £400 a week gift from the local authority over those 12 weeks. It does not have to be paid back. Families should always be told about this before being told about what I'm going to come on to on my next slide. So the idea, what's the point of a 12-week disregard? It's a very good question, because it's an awful lot of extra paperwork for not really that much benefit. And I think it was brought in originally back in 2001 to sort of try and fight off I think it was the Daily Mail, who kept running campaigns about the number of houses that had to be sold to pay for care and how wrong this was. So I think it was actually sort of brought out, oh, nobody has to sell their house, they've got time to think and make decisions. But really, most people, A, aren't going to get a house sold within 12 weeks, and B, they get to the end of the 12 weeks and might still end up doing the same thing, having to sell the property. So it was a bit pointless, but it's still there. People should still know about it. People should still claim it. And we spoke in the agenda points about selling the family home. And as I say, we certainly did it thinking we had to. And I suspect many families nowadays are still doing the same. But what if the property could generate some good rental income? Interest rates aren't exactly sky high at the moment. Is the property in an area maybe near a school, or a sought after area where families or commuters, for example, might be taking, really, really keen to get into rental property? So we might say use that 12-week period to have a think about it, to do some number crunching. Obviously, if you're a few steps ahead of me and you've done some number crunching and you thought, well, yeah, we could get the rent, but of course we've got to pay tax on the rent. And even if we allow for the tax and add the net rent to the pensions and the attendance allowance, it still doesn't cover the fees. We can't do it. We've still got a shortfall. Some people might think, yeah, but actually we could maybe equity release. I've heard about equity release. Why don't we do that? And then that could plug the gap. Now, it's really important to note that one of the main conditions of an equity release mortgage is that it has to be paid back when the person dies or moves into care. So it in this scenario won't work. You've got to really be an owner occupier. So it might work for funding care at home using care, a care agency and buying care into your own home, but you'd still have to pay the loan off if you moved out. So it doesn't really work, which narrows your options. However, the local authority or the government decided they would provide a solution to this, and really it's just a government-backed equity release, but they call it a deferred payment agreement or a deferred loan. So this could be a solution for the short term. So if you're just worried about cash flow and the fact that there isn't really much in the way of savings, the 12-week disregard will help, but you're worried about what happens next because it could take a few months for the house to sell, you could apply for a deferred loan for the short term. Or you could decide to rent the property out and apply for one of these loans for the long term so that the local authority cover any gap between income and fees. And they register a charge against the property and then it's paid back when the person dies. So all local authorities should offer one of these schemes. They can turn you down individually if, for example, there's already a mortgage on the house. If there's already equity release or a charge, they won't be able to help. They need to see at least a couple of years worth of equity in the property. So if it's low value, it might not be offered. And the property needs to be structurally sound, as you might expect. So they can say no, but they still have to have a universal scheme available. They can charge a set-up fee, they can charge interest, but the interest rate is much lower than high street banks. You still need to meet their care eligibility criteria. Remember, right at the beginning, we said not everybody does. Just because you might think you want to go into care, they might not agree you need to. If they don't agree you need to, there'll be no 12-week disregard, there'll be no deferred loan. Your other assets have to be under the threshold. So you can't apply for this if you've got 40,000 in the bank, but if the house still isn't sold and the capital drops to below 23,250, then you could apply for it. The beauty of this arrangement as well is that the local authority don't have to restrict the amount that they'll pay the care home. They don't have to restrict it to their rate. They can lend full fees because they're going to get the money back. So it's just a revolving pot of funds. And as I say, it follows on from the 12-week disregard. We have heard of local authorities just putting people straight onto these loans and conveniently not mentioning the free money that they should be getting for the 12 weeks preceding that. So again, not for everybody, but just be aware of it. And if you want more specific information, do let us know. We can't advise on the interest rates for specific local authorities or anything, but we can certainly have a holistic conversation about how renting out might stack up against other options. So looking now really just to our sort of broader self-funders, so that might be people who have already sold the property or people who have got investments that put them over the threshold of 23,250 or just general savings that put them over the 23,250. So they're very much self-funders from the outset. We take calls from these people all day, every day, and it's normally the sons and daughters, nieces, nephews, occasional solicitor, occasional neighbour who typically are acting as a power of attorney for the person who's gone into care. We do speak to the individuals who've moved into care themselves sometimes, but obviously where possible just to take away that kind of responsibility and administration will involve a family member wherever possible, but usually it is the power of attorney who gets in touch with us. They will share with us two main concerns. If they're looking at care homes, what can often happen if they've not dealt with this before is they get told the weekly fee. Firstly, they have to realise that is weekly, not monthly. That could come as a shock. But what they often do when trying to work out how much they can afford, can I afford this care home or that care home? What they might often do is, as I say, take the weekly fee, multiply by 52, and then divide that into the assets, into the savings. And it will last so long. But of course, they don't have a crystal ball. So is that enough? And what they may not have realised or forgotten to factor in is that the state pension, the attendance allowance, any private pension, all of that income really isn't going to be needed in a care home. It's not going to be needed to pay the gas or the electric or the Tesco shopping bill, because all of that is provided within the care home fee. So actually, we've got some income that we can put towards those care fees to suddenly make the savings go a lot further. So a very simple conversation just with us at that point when choosing a care home and just doing some really simple cash flow forecasting, it might prove that the money might last 5 years, not 3, or 6 years, not 4, for example. And that could lead to you making a different choice of care home. It is still an understandable concern. If you don't know how long your loved one will live in care, how can you possibly know whether the money will last? It's a worry. Literally off the back of that then is, well, if the money does run out, then what? Does mum or dad or my uncle, my aunt get asked to leave the care home? Do we as a family get asked to pay a top up? What happens? So these really are genuine concerns. And I have to be honest, we don't always have the answers. The care homes may have the answers to what would happen if the money runs out, but we can't speak on behalf of them. So what we will try and do is remove the concerns in the first place if we can, so that this situation of the money running out doesn't occur. And if it doesn't occur, we don't have to worry about it any longer. We can't do that in all cases. If we're talking to a family who say, even if we factor in mum or dad's income, the money's only going to last 18 months, maybe 2 years, then actually, with the best will in the world, there's nothing we can probably do to prevent that happening. All we can do is explain how to go about applying for local authority funding when the time comes, and encourage them to have an open conversation with the care home when moving in. But for people who have got enough money to cover their fees when factoring in the income for maybe 3 years or more, then for them, there is a solution that could take away those concerns. Now, as I say, I've been doing this quite a long time. We are approaching 2.5 decades. If I say it quickly, it doesn't sound so bad. But even when I first started enthusiastically advising in this arena, the statistic was that there's a solution that could take away those concerns, but but literally 85% of the people for whom it could be a solution will never get to hear about it. So only 15% of people hear about it. And I thought that was crazy. If somebody wants to buy a house, pretty much 99% of them know there's something called a mortgage. People that want an income in retirement, I would wager that 99% of them know there's a product called a pension. But here we are with people worrying about spending large amounts of money on care costs, worried that the entire estate will get used up, and not knowing 15 or 85% of them, sorry, not knowing that there is a financial product, a solution that could alleviate those concerns. So it hasn't, as I say, the awareness is still really, really low. That's why this is an important event, not just for you, but for you to potentially pass on to other people that could currently be in the 85%. The good news is, in a few minutes' time, you'll be not in the 85% any longer. So what am I talking about? And as I say, this isn't a sales pitch. Obviously, we do advise on this product, and obviously we do sell some. This is for you at this stage, just about knowing it exists. Because for most people, if you're anything like we were, there'll be one way of paying for care at the moment, and that is to pay as you go along, drawing down from investments, drawing down from savings, maybe selling a house and drawing down from the proceeds, using your income. But fundamentally, that money is depleting. So this is an alternative. It may not appeal, it may not work for you, but now at least you know there's something else to consider. You can insure care home fees. Now, I use the word insure quite loosely, but that's because people sort of understand insurance. But insurance, normally you would think you have to do it before the event. So you can't obviously insure your car before the car accident. You can't insure the house after. You can't insure the house after the flood. You can't insure the car after the crash. With care home fees, you can only insure them before you move, got my befores and afters, it's the heat, I've got them the wrong way around. You can only insure at the point of needing care, you can't do it in advance. You used to be able to, there was something called a pre-funded long-term care insurance that you could buy years and years in advance, but the products aren't for sale anymore. So you can only take out this type of insurance either as you're moving into a care home or after you've moved in. There's no time limit to after. It's just that as your estate depletes because you're spending money on care fees, it will look less and less viable as time goes on. But we have had people come to us. In fact, I did have somebody last week, unbelievably, their mum had already been in the care home since 2019, and they had just heard about this product and thought they might investigate it to stop the worry of the money running out. Well, I think mum would have been 89 or 90 back in 2019, so they would have already been really glad they did this, but they had only just heard about it. So it really is that lack of awareness. Now, the technical name for this product is a care fees annuity, not insurance. But the word annuity often gets mistaken and muddled, even by professionals, even by IFAs who talk about pension annuities. These are not the same thing. Where they are similar is that you're paying a one-off lump sum to get a guaranteed income. So that's the similarity. But if you think about it, if you have a pension, or you know people that do, you save into your pension pot for years and years and years, and then you trade the pot for an annuity. The insurance companies offering those annuities are anticipating paying out for maybe 20, 30, 35 years if you're retiring at 60, 65. You may be retiring in good health. You may be wanting a widow's pension to be attached to it. So what looked like a really big pot of money, when you convert it to income, a pension, it doesn't look great value. And that's where this sort of terminology comes from, where people say, oh, you don't want one of those, they're very expensive. That might be the case for a retirement annuity, but a care annuity is different. Okay, you're not buying them typically at 60. The average age of our purchaser is 89. And you, of course, have got some health issues and some care needs. Otherwise, you wouldn't be paying for care. So the similarity is that you're paying a lump sum up front, giving it to an insurance company. You're getting a guaranteed income for life. That's the similarity. But the main difference is that each and every one of these care annuities is individually underwritten and will take into account somebody's age and the fact they are much older than a pension holder, and their state of health. So even within the age category, even if I had a room full of 89-year-olds who all needed an extra £50,000 a year to top up their pension to pay their care fees, they will be quoted a different price by the insurance companies, because each one of them will have something slightly different on their medical records. They'll have slightly different care needs. Their day-to-day care package will look different. So there is no how much does it cost? It costs this. It genuinely is different for everybody. I will give you somewhere. I'll direct you to somewhere where you can get a sort of steer on this, but it really is case by case. Okay, so if I use the term gamble, I don't do it lightly, because these are risky policies, but not in the way that we understand risk with investments. With investments, the risk is that they could go down as well as up. And actually funding your care from investments definitely carries risk in the event that you live a long time and you might outlive your capital. The care annuity has a different type of risk. It has a risk around not living a long time and buying a policy that's based on a certain break even point, maybe 3 or 4 years, and the individual not living as long as that. That's the risk, because no money comes back to the estate. The insurance company keeps it. That's why they offer these policies. And they win on some, they lose on some, and they break even on some. But of course, they're offering these policies to hundreds and thousands of people. You only have one pot of money. So that risk, of whether you win, lose, or break even is much more significant if it's the only pot of money you've got. The insurance companies can afford to lose on some. So it is a gamble, and it is a gamble around how long the insurance company expects somebody to live. If the person lives longer than the insurer anticipated, the insurer still has to pay. These pay for life, no matter how long that is. But the flip, of course, is that the individual might not live as long as, or get even to the break-even point. And then, as I say, typically there's no refund. So it's understanding that pay-as-you-go insurance both carry their own risks, and it's understanding which is sort of most palatable. You could even combine the two approaches where you have a partial annuity and fund some from investments, but you have to make sure that the bit being funded from investments cannot run out. If it runs out and you don't have enough from the annuity, you're in a horrible position where the local authority won't pay because you've got too much income, including your annuity, but you haven't got enough money to pay the fees because the investment income has dried up. So it's really important. I'll talk a bit later about choosing an advisor and making sure you have somebody with experience who understands these background nuances, because it's not the product that's complicated. It's these sorts of risks that could sit behind it if you take advice from somebody that's not really experienced. Okay. So they are a gamble. Our job is, as an intermediary, a sort of go compare broker. You tell us the financials, we work out what's needed. We then go off to the market and get care annuity quotes from all the insurers that offer these products. We then put all of that information into a report for you, and that report will answer all the sorts of questions you might be starting to think about now. Can I take the income with mum if mum moves? Is it portable? What happens if care home fees go up? Do we factor that into the annuity, or do we sort of pay it out of the estate? What options do we have? And we hear you say that it's a gamble. We're quite risk averse, and we don't want to have that fear of all the money going if something happens to mum or dad in a few months. Well, you can pay extra to have capital protection. You can even buy these policies with a delayed start date, which makes them cheaper to buy, so you lose less in the event of early death. So there are ways to mitigate and kind of reduce that gamble. You're never going to get a no risk option, but you could do certain things to mitigate, and we will advise you on all of these things. The report will also go on to reassure you, for example, that the products are fully protected by the Financial Services Compensation Scheme. And as I said earlier, you can access all of that information, get all of that advice, and walk away, if it's not for you, with no fee, no invoice to pay. Now, let me just run through a brief case study, just because visually it might make a little bit more sense. This is a real person. We changed her name, we changed her photograph, and it is pretty representative, to be honest, of the sorts of families we talk to. So this is a lady aged 88 who had been living independently in her own home, but had had a stroke, and that was no longer feasible. Prior to her stroke, she'd actually built up connections with a care home in the area that had run a few community events, and she had already decided that if she needed to move into care, which one it would be. But now that we're sort of at that decision point, she and her family are concerned whether she actually can afford it. So that's where they kind of engaged with us and shared also that what she really wanted to do was make sure some of that estate was left to the grandchildren and some of the charities. So we dealt, as I say, with the attorney as the daughter, quite standard, who shared with us some information about the finances. I've simplified a little bit here, but she told us that the care home they were looking at was 1,200 a week, that her mother she is already claiming attendance allowance and had pensions and AA totaling 15,000 a year, so a shortfall of just shy of £48,000 per year. Her asset position: cash at bank, £50,000, and a property that they had decided to sell. She was not going to be eligible for 12-week property disregard and not eligible right now for the deferred loan. So she really is going to have to go it alone. So we talked through those two options. You could pay as you go along, take investment advice, see if you can make the money grow a little bit. Could the money run out? Yes, depending how long she lives. We forecast that it would be around about 6 years from now that the money would run out. This was assuming fees going up by 5% each year, pensions going up by 3%, and any growth on that money being sort of taken out to pay for the hairdressing and chiropody, etc. So, aged 89, is she going to live till she's 95? That crystal ball would be very helpful. So that is a viable option. We're not saying for 1 minute that it's not. But what we did was go and research the alternative and find out how much a care fees annuity would cost to pay the 47,400 per year. Forget you've seen these figures because they are different for everybody. So there's no point saying, oh, but you said in that presentation it would cost this. This is what it cost for her in her scenario, and this was for an annuity that was just going to pay a flat 47,400 a year because they decided to cover fee increases from the money that was left over from investing that. So you can almost see a sort of 50-50 gamble, can't you? You're sort of gambling 50-55% to protect the other 45-50%. Is that a risk you would take? Well, that's for you to decide. Is it a risk that they would take? Yes, they did. As far as they were concerned, this gave them absolute peace of mind and guaranteed that there would be money left for the beneficiaries and the charities. So it makes the graph look very, very different, a big dent at the beginning, but then it flatlines and it can't run out in this scenario. This assumes all personal expenses were met from interest on that remaining capital. Obviously, if they didn't take that or the interest was higher, you'd even see that line start to grow again as the money would build up. So obviously, if she moves to a more expensive care home, we might have to look at a second top-up annuity, for example, but we'd have those extra costs to incur if we had gone pay-as-you-go or investment route. There's a good chance that the funded nursing care might meet the gap. So, we'll do some forecasts, of course we will, to make sure it's future-proof, but the family felt that this gave them absolute peace of mind in a way that funding from investments did not. So you can see the real reasons. For them, it was about ring fencing assets. It was really important that there was something left to pass on, but not everybody's bothered about that. Some people will be prepared to spend everything. But what we are seeing more and more is concern about the local authority getting involved, and the local authority either saying, no, we won't fund you. We don't think you need to be there, or we're not funding you yet because you shouldn't have chosen such an expensive home. There are cheaper homes in the area you should have chosen if you're going to come and ask us to pay. Or the concern about a top up if the care home and the local authority can't come to a mutually agreeable fee. Might the family be asked to make up the difference in order to stop mum or dad moving? So other reasons than just protecting the remaining capital. If somebody, and that is, sorry, the key thing in having one of these, you're never going to get local authority funding. You are cutting them out completely by virtue of having this extra income. You won't get state support ever. So it does have to be future proofed, and that is why you need to talk to somebody experienced that can spot any holes in the forecasting. If you bought one of these and subsequently the individual qualified for NHS funding that we touched on, you still get the income. The NHS pay the care home. You don't need the annuity to pay the care home, but the annuity pays the individual. It is then subject to a small tax charge, but only on part of the income. So as I've said before, just to reiterate, I think we're quite a unique model. If you go to some advisors, they might charge a research fee. They certainly might charge a report fee because this is all we do. And as I say, we do a large volume, and we have that low cost business model where we're doing telephone advice, email advice, etc. We won't be charging you for finding all this out. So Mrs. Evans' family could have looked at that care annuity report and said, no, actually, the risk is too great. We're going to carry on as we are. That's absolutely fine. They would not have had to pay a fee, and they could at least now know that they've made an informed decision based on facts. We do get paid a fee if a purchase is made. We're not a charity, but that fee is already built into the care annuity quotes that you would receive. So we think that's a fair way. It's not putting barriers up. People aren't sure if this is for them until they get all of the facts and information. They don't want to be charged fees for finding out. That's our experience. These are the 4 insurers, and there are only 4 that offer these policies, but you cannot, as a customer, go direct to them. And as I've said and implied a few times, it's not that the product is complicated. You might feel you know enough about it to go and ask for a quote, but it's that experience of whether you should actually need one, or what happens if this and what happens if that. So the insurance companies won't allow you to not have qualified advice. You've got to come through an advisor to get their quotes. And in choosing that advisor, I'm just going to give you could argue these are really biased tips, but they're not. You should choose an advisor who is at the very least accredited by the Society of Later Life Advisors. So look for that logo, check out the advisors on their website. But word of caution, some of those SOLLA accredited advisors has never given advice on a care fees annuity. They might know the theory of it, but they haven't actually ever gone through the advice process with a client, which may seem surprising, but later life covers, for some people, post 60 or post 70, it covers decades. So many of these advisors are much more holistic and will be looking at, that whole issue about pensions and making sure your income lasts, which is a really, really important and niche area of advice, but it's not care fees funding. So within SOLLA, you would need to look for someone who's a care fees funding specialist. That their website looks and breathes care funding advice, not investments and tax advice and pension planning. So that would be a good start. Making sure you can easily find them on the FCA website, on the register, would be a good tip. But I think the most important thing is that you get independent testimonials from clients, and independent testimonials about care fees annuity advice, not about pensions, because it's a completely different skill set, completely different legislation, completely different products. So we capture ours on Trustpilot. So if you type in Eldercare Solutions to Trustpilot, you'll be able to read our client reviews. Anyone else you're thinking about, please do the same. And what I would say to you is do all your due diligence here at this point in choosing a care funding advisor. Stick with one, instruct one, because you're going to get the same quotes from the same 4 insurance companies, whichever advisor you instruct. But if you have 2 advisors running in parallel, only one of them is going to end up being able to be paid, which perhaps isn't fair. But most importantly, the second advisor on the case gets no access to anything that's going on in the underwriting process. So only one of them will be able to give you updates. Now, we at Eldercare have somebody whose full-time job is to keep on top of these medical requests, to make sure the quotes are coming through when they should. No other company in the country has somebody dedicated to just making sure you get the quotes as quickly as possible. That's a promise. So I think do your due diligence around the advisor. If we're ever instructed and we're the second advisor on the case, we usually say, we can't help you because we don't have access to the system if we're second on. Okay, so we're often told to shop around. Here, I agree, shop around, but shop around for your advisor, for their experience, for the testimonials, and then stick with one, because you're going to get the same quotes from the same 4 insurers regardless. Okay. So just in closing, here is what might be a useful page of our website, partially because it's got our telephone number and email address that I promised you on there. And as I say, remember, you're getting this recording so you can grab it at a future date. But on our website, there's a tab for care fees annuity. And within it, you'll see that small circle there on the bottom third. It says request a care fee annuity quote. If you go through to there, you do not have to fill in lots of personal details and medical questions. It's not a quote like that. It is a ballpark figure. It's to give you an idea of what a care fee annuity might cost. So all you have to plug in is the person's age, how much income they have, and what the care costs are, and it will give you an estimate of likely care annuity fee. This is collected from data of hours of all the quotes that we've obtained over the last couple of years, categorised by the person's age. So we can say, well, the average cost for a care annuity for an 83-year-old is, and that will be a good indicator. Obviously, when the medical underwriting is done for your mum or your dad or your aunt or your uncle, it will be different. But I think just for the purposes of, I haven't got a clue what one of these might cost, give me an idea. That's exactly what that calculator is designed to do. If you fill in the bottom section, which puts your email address and your telephone number and a note, if you press that and it goes all the way through and says thank you, it's been sent to us to get back and contact you. If you then don't hear from us for a day or two, please contact us anyway, because something's gone wrong, because we always respond to those within 24 hours. So if you think you've pressed the button and are expecting a call back and it doesn't happen, please just email us or phone us anyway. So hopefully that has given you a bit more of an idea about the care funding system. You now know broadly how the local authority means tested system works. You're aware that there is an NHS funding stream, and you now know what puts you into the self-funding bracket. You know that the lifetime cap isn't happening. You've heard about attendance allowance, 12-week property disregards and deferred loans. So might not be applicable for all, but at least you know that they're there. And you're now no longer in the 85% of people that have never heard of a care fees annuity. As I say, it might not be for you, but at least you know about it and you can make an informed decision as to whether it is appropriate for your scenario or not. So thank you very much for tuning in. Please do pass this on to others once you receive the recording if you feel it would be helpful to anybody else. And then obviously if you have any specific questions about B&M, their homes, you've got Angela's details and I know she'll be happy to help. So I will close the event now. The recording will be with you Monday latest. So keep cool everybody and have a wonderful weekend. Thank you.